The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters. Thanks for being with us this week for the show, and this week our regular tax special with Julia Hartman. In addition to the information that you receive, the show is your chance to get your questions answered by an expert. And when you do so, you'll also get a copy of one of my 8 books. And this week I'm giving away Investing in the Right Property Now, which is all about the macro and micro influences of the economy on an area's growth performance. To get your copy, email a question to me at pim@mypropertytv.com.au, send it in a message on Facebook, or pop it into a comment and then watch at the end of the show to see how to get your copy. If you don't have a question, you can get that book and any other book that I've written either via my website, destiny.com.au, or through most bookshops. Let's get to my guest tonight, and Julia Hartman is a chartered accountant and the founder of Tacs Accountants, which has 13 offices Australia-wide. She has written books on the subject of property and tax and is indeed a guru in that area. Tonight, I thought that we would focus on buying your own home. Most people think there are no tax consequences of that, but you may be surprised. So to tell us more about that, let's welcome Julia to the show. How are you doing, Julia?
Good, thanks, Margaret. How are you?
Good. I've got a lot of questions for you tonight because I know that buying your own home isn't necessarily as straightforward as people believe it to be when it comes to taxation. Let's start with the case where you might buy a property to live in that has previously been tenanted. So those tenants may still be there when you settle because it could take a little while before you can give them notice to get out. Or if you bought a property and you might want to do some renovations or just leave it vacant for a little while before you move in. What are the tax consequences of that scenario?
They're both treated very differently, Margaret. If you've got someone living there, you're in deep trouble because you've got to move in as soon as practical to get your main residence exemption on the property. So if it's got someone else living there, that's not the case. So for that period of time, it's exposed to capital gains tax, and there's no resetting anywhere. So for the whole time you own it, you work out the whole capital gain and then you bring it back to that percentage you have to pay the tax on, which means record keeping for the whole period of time.
Julia, if I can just ask a quick question. You say that the tax office says that you have to move in as soon as is practical. I would argue that if you've bought a property that has a tenant in it that you didn't put there, it isn't practical to move in until they've moved out.
Yeah, no, that's a nice argument, Margaret, and I like it, but no, that's exactly how they get people, and they do come after them many years after they've sold the property and not had any capital gains tax records because they've declared some rent in their tax return. It's been used to produce income. And you can put in the contract that you want vacant possession, and that's what I suggest people do. They just sign a contract to agree to settle once vacant possession is available.
I guess it's a trap for people because a lot of people wouldn't realise that that's the case, and therefore they'd be wanting to settle as soon as possible and be happy to potentially settle and even get that rent for those first couple of weeks until the tenant can move out. It is different though, isn't it, if you don't move in straight away, and if it's a month or two and you might do some renovations or whatever, that doesn't necessarily trigger a capital gains tax event, does it?
No, that's you can actually backdate your main residence exemption for up to 4 years on the property if you're doing something like building on vacant land or doing renovations to move in, or as long as someone else isn't living there is the key to that.
Okay. All right. Look, my next question is one that comes up for me all of the time. What happens where, for whatever reason, somebody's accountant advises them to buy their family home in either a trust or in a company name?
Okay. You don't get your main residence exemption unless it's in an individual name. It can be either spouse's name, it doesn't have to be both, but that's the only way you get the main residence exemption. So capital gains tax is a tax on inflation. If you buy it in a trust, at least you get the 50% discount. But if you buy it in a company, you don't even get the 50% CGT discount. So you can imagine the amount of tax that would happen once you get around to selling it. And sometimes they're recommended to do that as a form of asset protection, but there are other ways of mitigating that problem.
Yeah, I would think so. And I'm sure that all of those people out there who are being advised by their accountant to put their family home into a family trust in order to protect them from being sued in the future, I'm sure most of those people don't realise that because they don't own the property, then it's owned by another entity that isn't living in it, and therefore they can't have their own main residence exemption over that property. Okay, Julia, now for the next one. At the moment, things can be tight for some people. Some people are out of work, some people are on reduced hours, and a lot of those people are thinking about renting out a room in their house to friends to help them manage the mortgage. What kind of dangers are there in that?
Well, it's using your home to produce income, and that's unlike when you move out and rent it out where you've got the absent rule for 6 years. That doesn't apply in this case because you're not absent, you're living there. So what happens, because it's used to produce income, it resets the cost base to market value at the time you do that, if it had been covered completely by your main residence exemption up till that date. And then, you obviously declare the rent and a portion of the expenses, based basically on a floor area basis. So you might say the interest expense for the whole house, half of it is shared, so 25% of that half, and the other half, they might get 25% of their own designated area, and you have 25% of their own designated area. So you can see there that comes up with about 50% on floor space. So yeah, you get to deduct 50% of your interest, but by the same token, 50% of your capital gains tax main residence exemption is lost. And the worst part about it is that you've got to start keeping records from that point.
So essentially what you're saying is that the minute you have people come in to rent rooms from you, if they're paying you rent, then whatever portion of the house they're using becomes income producing. Proportionately, you might be able to claim your expenses to that same proportion, which is fine. But at the end of it, the worst part is that whatever it's grown by, that same proportion is going to attract capital gains tax.
Yes, and it's the record keeping, I reckon, is the worst thing.
Absolutely. So I guess one way around that is to not rent out rooms, but maybe just get some people in to help you pay some of those expenses like electricity and water and groceries and a share of your ongoing expenses. That's probably a better way to do it.
Well, it doesn't count if it's mortgage repayments, that share of expenses. It's actually more a case of what they've increased expenses by, so it doesn't really help you.
Okay, so I guess I'm saying don't charge rent.
I know what you're trying to say.
if you have someone in a room, just get them to pay a portion of your water bill and electricity and things like that instead.
Yes, but you'd only be saying, all right, they've increased the water by this much and they've increased the electricity by this much, that sort of stuff.
Right, okay, so they can't help you pay the existing electricity and things like that. Okay, look, I've got another one here. A couple of years ago, or many years ago, a family member in my family used to buy property, move into them and do them up, and after about 8 months to 12 months, they'd move out and sell the property and then go and do it again and again and again and never pay capital gains tax on the pretext that it was always their principal place of residence. I always thought that this might be stretching it a little. What's the actual view on that?
Okay, if you are in the business of doing something, in other words, a one-off profit-making motive, then you have to declare that in the profit you make as income. Now, capital gains tax comes in after income tax. So if income tax catches you, you don't even get to the capital gains tax legislation. So up here in the business of buying houses, doing them up and selling them, caught there. If you can't get down here to the capital gains tax legislation, then you can't use the main residence exemption. Didn't get that far. It's only in the capital gains tax legislation that you get your main residence exemption.
Right, okay. I guess so the point that you're making then is if people are doing it over and over again and making a profit, then technically, even though it wasn't rent, the fact that it's a capital gain is considered to be income. You are then considered to be using your principal place of residence for income producing purposes, and that's why there's no capital gains tax exemption.
No, no, it's a business. It's not using your principal place of residence for income producing purposes. The fact that you live there is totally insignificant. It's the reason you bought that property was to make money out of reselling it. So you get caught as a business.
I think there'd be a lot of people in Australia today who'd be very surprised by that and are probably guilty of having flipped houses and lived in them to try to avoid that whole capital gains tax. All right, let's go into what I see a lot of people doing now, which is buying houses with their children to help the kids out. So there's a number of different structures that they might employ in order to do that. What are some of the capital gains tax traps that we can find there?
Well, it's great if they just borrow a bit of money themselves and give it to their kids to say, well, here's a bit more towards your deposit. That's uncomplicated. They've only taken on a liability for a little bit of the loan. They're not mixed up with their kids' problems, and that's what I'd strongly recommend. But what happens is quite often they go to the bank and they say to the bank, look, we want to help our kids get a loan. They haven't got a full deposit, so you can take a bit of security on our house as well to get it up to the level that you want. And the bank say, well, we feel that to look after your interests too, you should go on the title deed because your house has been put up. And by the time you put your house up, you put your house up for the whole of the loan instead of the little bit you borrowed to help them with the deposit. And if your name's on the title deed, well, then your portion of the house is not covered by your main residence exemption because you've got that over another house. So when eventually your kids can afford to take it all into their name, you've got a capital gains tax event triggered by a market value. You're selling them the house at market value at that time. Now the way around that is to enter into a contract to sell it to them at the date you're forced by the bank to buy it with them. And that's market value, so they're the same. So they might not settle, so the contract's drawn up by a solicitor and the solicitor says, righto, 5 years till settlement, but here's the contract in place. The bank doesn't even need to know about it at that stage. And then 5 years down the track, when the bank will free it up because they've got enough equity, you settle, and that's not it's still a capital gains tax event, but it's back here at market value when they bought it, so there's no actual capital gain.
Sounds like a great plan. Julia, a lot of people aren't aware of the consequences of owning a large acreage, and these days everybody wants to have that lifestyle change or that tree change, so they're out buying these big acreages. There's also traps there, isn't there?
Well, you only get the main residence exemption on 5 acres or 2 hectares. So anything other than that, you're going to pay capital gains tax on. And you need to keep the records for that. It's not the end of the world because you've got that extra land. And you also need to think about how you might do that. You might say, well, that's floodplain land down there, so it was worth nothing when I bought it, it's worth nothing now. Or you might start growing trees on it and selling the fruit at the market so that it's in a business, and therefore you get the small business concessions when you sell. But yes, anything over the 5 acres or 2 hectares is not covered by your main residence exemption.
That's another trap. And Julie, what about the case where homeowners might be sitting on a nice big block, they find out that it's subdividable and they decide to chop off the backyard of a house that they live in for the purpose of getting a bit of cash, a bit of free land that you can sell off? There's going to be some tax to pay on that, isn't there?
Yes, because your main residence exemption is with your dwelling. So if you sell a bit of land that hasn't got your dwelling on it, then that's got no main residence exemption. There's not even a concession for the time that it was attached to your main residence because it's not a dwelling, it's only a piece of land. So when you sell that off, you're up for capital gains tax. There's no reset to market value or anything. You go right back to when you first bought it and apportion the purchase price for that land and then increase the cost base by various things of maintaining it and rates and interest over the time, that portion, but also the subdivision costs, but half the subdivision costs, because remember you've got 2 titles out of those subdivision costs, so half of it was for your main residence and half of it was for the land you sold.
Okay, well that sounds fair enough. This is my last question, one that's not quite as common, but I'm sure there'll be someone watching the show today who may have either been in this situation or may become in this situation. What about where you buy a property that might have previously been used for a business, like a doctor's office or potentially a farm? Is there anything that you need to be aware of there?
Oh, I had a horror case like this. A poor woman bought a house down in Sydney that was, it was a while ago, it was for $500,000, and it was a chiropractor that she bought it off that had been used for their practice. So she signed a contract because it was at auction, and you know how it goes, you don't get to get legal advice, you just sign up what they at the time, and it had a going concern clause in it. And that means that when she stops using it as a going concern, as a business, she has to pay 1/10 of the purchase price to the ATO in GST, because she's, first of all, by signing going concern agreement, she's agreed that she'll be registered for GST, and then she's treated as if she stopped being registered for GST and the adjustment periods apply, which means she has to pay back the notional input credit that she got on the purchase of the property.
That sounds horrible. I mean, you pay $1 million, that could be $100,000 essentially that goes back.
Yes, rarely happens, but worth the warning, Margaret.
Absolutely. Well, Julia, we are going to head off for a quick break, but while we're gone, you can send those questions, be they tax related or otherwise, straight to me at pim@mypropertytv.com.au, and I'll make sure that at some time we get an answer for you. Stay with us. We are off for 2 short minutes, and we're going to see you when we return. Are you a do-it-yourself investor who likes to have control over your own financial circumstances? You may not know this, but it's a fact that most failed property investments happen because the investor didn't have the skills or knowledge to pick a good property. Don't let this happen to you. By undertaking our comprehensive, online and fully interactive property investor education course, you'll get all the knowledge that you need without leaving home. There's simply no other course which offers so much, and you'll emerge a fully fledged and confident investor, ready to tackle head-on your next investment property purchase. Don't join the thousands of property investors with dud properties. Get educated now and take your financial future into your own hands. Destiny, empowering you to buy the right investment property.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.
Thanks for staying with us. You're watching Property Investing Matters. Joining me tonight and talking about the common mistakes that people make when they buy their own home is tax guru Julia Hartman from Tacs. You can join us with your question, and if we answer it, you will receive a copy of my book, Investing in the Right Property Now. Let's get back to our discussion tonight. And Julia, we've got some questions from viewers, and hopefully you can help me to answer those. And the first one, we're going to go to that now, as soon as I can get it up on my screen. There we go. It says, "Hi Margaret, I'm just wondering what you envisage may happen to the rental market in the April, May, June period after the government's eviction and rental increase moratorium and JobKeeper payments cease. Firstly, do you think they will cease, continue or be modified for another 6 months or so? Secondly, what may happen to the rental market? Will there be a lot of evictions causing rental increases, decreases, etc.?" Oh, Julia, this one really does require a bit of a crystal ball. Do you think there's going to be, JobKeeper, no one really knows, do they?
Well, I think that they've already put too much money out there into the economy. It's overstimulated. People have not been able to buy smashed avocados, so they can afford to buy homes. There seems to be a lot more money out there. I know there's pockets that are screaming, but I don't see doom and gloom coming around the corner, especially for the regions.
Yeah, look, I'm in agreement. And in terms of will we see rental, decreases as a result of presumably mass evictions and then a lot of properties vacant and more people trying to get in, I don't see that as being an issue myself either, because at the present time there isn't as many people who have been affected by that as you might think. There aren't as many people who have asked for a reduction in rent as you might think as well. There aren't as many people sitting in houses not paying rent and therefore liable to be evicted when it's over as you might think. And at the moment in many areas there's a huge rental shortage anyway, and we are seeing 20, 30 people applying for every property that's coming onto the market. And I'm not really sure why that is, but that's what's happening right now. And therefore all we would see is a slight reduction to those numbers, but still hefty numbers and pretty strong rental market going on. I just don't see that this big cliff that everybody has thought will be coming along in March will occur. And I think the situation in regard to once we can keep those borders open, I think recovery may come about a little bit more quickly than a lot of people are now saying as well. Let's go to our next question, Julia. This one comes from Carol, and Carol says, "I'm definitely deciding to sell this year, but always nervous with what the market is doing. I have adult children that rely on me to guide them as they both have mental health issues. I feel it's time, as the house is a pull down on 623 metre square block in a growth area. We live next to a park and this is the only house left. The other blocks have units on them. Wondering if you have any suggestions on how to sell it." Not really your area, Julia, but what do you think?
Oh, well, certainly developing properties is my area, small subdivision, mum and dad type situations. But with her circumstances, the key here is that if she demolishes that house, she loses her main residence exemption on the property retrospectively. So she doesn't want to be the developer. She doesn't really want a joint venturer coming in unless she can afford to live in one of them that remains. So I'd be inclined to think about applying for the DA and then selling it. That won't change your main residence exemption. You'll still get everything capital gains tax free, but it will increase the value of the property, because from a developer's point of view, the uncertainty is the problem. The money that they tie up, waiting to see if they can get it through council, even if they're reasonably confident. Still a lot of time that things tied up. So I think, or I feel in most cases, an owner can increase the value of their property by getting that DA beyond what, in a more efficient way, effective way than what the developer can.
And Carol, this is of course going to depend upon your property being big enough to add a couple of units to it, and it may or may not be depending on where it is. So your first port of call is the council to find out whether or not you have a property that is zoned anything other than an R1, so an R2 or an R3 zoning, presuming that you're in New South Wales. You haven't said where you are, so it could be any modification on that. Find out what can be done with your block first before you work out the best way to sell it, because it may be that nothing other than a house can go on it, and that could be not such a good thing if there's units everywhere, or being next to a park, it could be the one that needs a specialist real estate agent to sell that at a premium price for you. But definitely Julia's suggestion is a good one. If it is developable, applying for that DA could be something that would really help to get a better price for it upon sale. Let's go to our next question now, and I know this one is right up Julia's alley. It's from Jenny. And Jenny says, "Hi Margaret, my partner of 18 years and I are about to negotiate a property settlement as our relationship has broken down. We bought an investment property together about 5 years ago. As part of the settlement, I want the investment property to be transferred to me. As I'm 60 and I won't have much money otherwise from the settlement, I think I'll have to waive my right to any of his super to get the property. I think I'll be keeping the property tenanted for income while I search for house sitting opportunities to provide a roof over my head. I've never budgeted to retire single. This means if and when I ever sell the property, it will be subject to capital gains tax. My question is, to include my ex-husband's share of capital gains tax to date against his equity, how do I figure that out?" Quite a complex issue. You probably can't answer all of that, Julia, here on air.
I'll try and keep it succinct, but it gives you the horrors, doesn't it, Margaret, these circumstances? So many women are finding themselves in this position. I do want her to encourage her to think seriously about that super, because she's only 60 and the super won't account towards any social security she might get. It's a nice tax concession there. The house does have its own set of problems, especially if she can't get the capital gains tax liability taken into account. And what does worry me is if they've only had it for 5 years, then it's probably got debt on it. So what I'd like is if we've got an email address for her, we might, I'll send her my capital gains tax little spreadsheet so she can calculate it out. But what she's looking at is she steps into her husband's shoes, as if she bought it right from the start, just in her name, and she gets the whole cost base and anything that she adds to that, and against the market value at that time. So because it's part of a property settlement on divorce, that doesn't trigger a capital gains tax event. She's deemed to have owned it the whole time. And I think she's absolutely right that she should have his capital gains taken into account as part of that property settlement, because he's getting the nice tax concessional super payout. And I'll send her the spreadsheet to help her work that out, which is quite easy to guide through. But it should be a pretty simple calculation if it's been a rental, because most things have been claimed as a tax deduction. If they've been claiming building depreciation, of course, that'll have to be written back too. But that's all there to prompt her in the spreadsheet. So do we have an email address for her, Margaret?
We will definitely get that to you, Julia. And Jenny, I really do urge you to discuss this with an accountant and not just try and take your own advice on this. Julia is right about that superannuation. People underestimate the true value of it because it is so tax concessional. And this isn't advice to you, but you certainly need to play out the scenario of selling the investment property outright, taking your share each, and maybe you using some of your share to get back into something else, depending on the value and the debt on it. But you might be able to get back into something, a small unit somewhere that you can still rent out. I'd much rather see you explore some of those options. So maybe, half the super and then proceeds of the house, and see how you can play all that one out as well. the bottom line could be vastly different depending on which pathway you take, and you need an expert to help you to calculate that bottom line before you go making any rash decisions. Next question comes from Jill. Jill says, "Hi Margaret and Julia. I have a long-term let apartment that I'm thinking of turning into an Airbnb. I know the income will be good as it's in a high demand area, but what are the tax implications I should be considering first?" A lot of people are thinking of this, Julia, at the moment because Airbnbs are in demand given the situation that no one can leave the country. Is there a tax consideration here?
Well, fortunately not, because it's never been her main residence exemption by the look of it, so it's pretty straightforward. It's still a rental. The only little catches I'd worry about is if she ever stays there herself, then she destroys her ability to claim further ongoing plant and equipment depreciation. So say she's depreciating an air conditioner and she goes and stays there for a month herself, and even though she didn't turn the air conditioner on because the place has been used for her private purposes, that's it. It's now second-hand equipment. She can't depreciate it, so she should stay clear of it. Also, the ATO don't like you trying to negative gear Airbnb. They get very picky about whether you're very active in trying to rent it out. You know, they examine every little bit of vacancy. One of the things I particularly dislike is they'll say, no negative gear because you really weren't effectively trying to rent it out because you didn't list it on all the different websites that you can for these sorts of rentals. And that is particularly bothering because I do strongly encourage my clients to only use Airbnb because they do a far better vetting of your tenants, and that's just so important. For a few $100s rent and they rent the place, so very important to just go Airbnb. But I've seen them try and argue, oh, you didn't put Wi-Fi in, you would have got, you know, more tenants if you had that, or you should have a coffee machine there, you know, so pick. So they really don't like Airbnb.
Yeah. Look, some people are in the position that I'm in. I've got an Airbnb up in Early Beach, and they could never argue that we're not doing our best there because it's never vacant at the moment since just after the main COVID scare finished. We've just been literally back to back. Someone moves out, someone moves in, and I think there might be 1 or 2 days a month that there's no one in it. But apart from that, it's very vigorously rented right now, so there's no question. Julie, there is one more question. It comes from Kevin. It's a little long, but let me read it to you. It says, "Hi Margaret, I'm 60, my partner 56, own several properties jointly, 50% each, and we have joint home loans on all properties. I expect to retire in June 2021, but my partner will work a further 10 years. Lucky you. Once I've retired, then is it possible to split the current joint home loans 50-50 with my half being 100% offset? This will allow my partner to continue to claim home loan interest against her income. Will the ATO allow this, please? Let me have your thoughts and any other advice on our current scenario." Julia.
Okay, Kevin, I have a case for you. It's called YPFD. It's a 2014 AAT case, and you know, it was tried and it was not allowed. But what happened was exactly the same situation. She continued to work. He retired. He took his payout on retirement and paid it off the loan. And she said, right, well, that's now only the interest is my share. And absolutely not. Still split 50-50. It was joint funds because they were married. Joint funds went in. Joint borrowings, jointly owned property, still split 50-50. So you have to do something a bit different to this, and I can't give you any guarantees, but I would start with at least refinancing the loan if you can, and I'd hit the current loan at the same time. So your wife goes and gets a mortgage for her half, you get a mortgage for your half, and then you both together put your amount, your 50% each into that loan, pay it off at the same time. Then you've got your 2 freestanding loans. Then you can offset your loan or pay it out or whatever you want to do. That's going to give you the best scenario for an argument. You might want to go for a ruling before you do it, but I can't see any real downside of not giving it a try. So that's up to you. But another thing I want you to consider is you're retiring this financial year, so I'm assuming you've got very little income next year, is to prepay the interest on the loan. You can pay it a year in advance to get the deduction in this year. But that's not a long-term solution. You've got another 9 years of this unequal situation. If you do go for ruling, please let me know. I'd be very interested. Another argument is, because you say you've got several properties. Now, if you've got 9 or more, and this is one thing that did come out of this YPFD case, that they had more than 9 properties. So the AAT found that they were in business. And that allows you to maybe say, look, it's a business of having all these rental properties, so even though we own them 50-50, we've got a partnership agreement that says he gets more than her because he's the one running around doing the lawns and maintaining them and all that sort of stuff. So he's working in the partnership, she's not. It's business, so he might get 80% of the profits rather than 20%. But of course, this is about profit distribution, so it's not going to help if all the properties are negatively geared. But you might go through the portfolio and find some are negative and some are positive, and you can work around that one too.
Certainly some creative ways there, Kevin. A personal ruling is relatively easy to get. You can download the form and fill it out and put it in and wait a month. And the tax office will then deliver a ruling that's appropriate to you only. It's not a public ruling, so it's appropriate to your circumstances, but at least that way you will certainly get a ruling on what you personally are allowed to do, and then that stands. You might want to contact Julia. Her email address will be at the end of the show, so that you can just clarify some of the things that she said to you today and maybe get your head around that a little more as to how she's explaining that. But it's almost what you said, only instead of splitting the loans, which the bank wouldn't allow you to do any, the bank would require you to refinance them. It's a refinance, 2 loans, repay the 1 loan, but it's a loan in each of your names instead of each 2 loans being in joint names. So certainly clarify all of that with Julia as well. Well, that is the end of the show for this week. I won't be here next week, but we will return on Wednesday the 24th of Feb, so be sure to tune in again then. If you missed past episodes, they're available on the website for a month, after which a free sign up to destinylive.com.au will get you not only every past episode, but plenty of other great educational videos that I've put together over the years. If we answered your question tonight, send an email to pim@mypropertytv.com.au with the subject book prize. Tell me your name, address and which question you asked, and your book will be sent to you straight away. Thanks for being on the show tonight, Julia.
Thank you for having me, Margaret.
And your email is hartman@bantax.com.au?
That's right.
Or they can go directly to the website. Probably easier to just get you through the website Bantax, and that way they will be able to have a look at all of those wonderful questions and answers that you've got up there. And I think you offer a bit of a service where someone can go on, pay a small amount of money and get some guidance from you as well. Is that right?
Yeah, we have an Ask Bantax service that I always answer.
Okay. Excellent. So you can get all of that from bantax.com.au, which is bantacs.com.au, and Julia would be only too pleased to help you out with anything you need. So we will definitely be back in 2 weeks' time. Don't go away. Make sure you go to the website to have a look at all of the things that we can offer at destiny.com.au. We've got a lot of video blogs up there. My new YouTube station, Margaret Lomas channel, will also give you some more free education, and there's all my contact details on the screen for you to see if you need to contact me. Remember, our new property match service is here, and it's a great new way for you to get all the support you need to buy a property which is just right for you without the expensive price tag of some property advisors. Just drop me a line if you would like to know more. Have a great week. I'll see you in 2 weeks.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.